It is the fourth Sunday of the month, and here at the Biblical Institute, I will redo our financial freedom ministry. So, what we do is, well, first of all, our pastor's vision is for the church to be debt free. And when I talk about the church, I'm not just talking about this building that we haven't been able to use for the last couple of years on a regular basis, but we will be opening up soon next month for in person service. But I'm also talking about the members of the church. So we want you to be free of debt because debt can be an albatross and anchor that is keeping us from being able to have the freedom to invest in things. It brings a lot of pressure, and we just want to free you from that. So the vision is that you'll be able to tithe 10%, save 10%, and live on the other 80%. And that's what this platform is being used for. Those of you that are normally been here, you know that I am not Sister Claire Degree, but I'm filling in today. And I'm going to be doing a series during this tax time to kind of give some information about taxes to help you be more informed and to take deductions that you need and help you in in that manner. So with all that said, first of all, I want to open up with a quick word of prayer. Heavenly Father, we thank you for this day. We thank you for this moment, this opportunity, and this platform that's been given to give information that can help your people. We ask that you come into the midst, that you bless us, that there's a word that can help someone be encouraged, help someone go through, help someone with the situation. We ask these things in your precious Son, Jesus' name. Amen. So now, for those that you do not know me, or for those that you are new, welcome. For those of you return, thank you for coming back. What I'd like to do today is I'm going to do a little or a recap rather, of what it went through last week, and also answer some common questions. So just to give you an idea of, because you may be asking a question, well, why should I be listening to what you're saying? Which I like your viewpoint. You need to make sure that you're getting information from a reputable source. So just to give you a little background about myself, I am a CPA. I've been doing taxes for over 30 years, been a CPA for 20 years, and I'm out there right now working with the public, helping them with their tax situations. And I've also taught on the academic level, teaching undergrad and graduate students in college accounting at Roosevelt University. Okay? So, an important thing that I talked about last month was you want to file the taxes because not filing your taxes can bring you additional costs. Um, when you go beyond that 90 days, your tax liability could as much as double. There's a minimum of 100% of your taxes or $435. And we want to avoid those particular situations. So let's have a conversation about how we can avoid delays. So I'm going to go through some common questions that come about and we'll provide the answers for that. So question number one that I want to address is, how can I avoid delays? I talked about this briefly last month, and one thing we want to do is avoid paper at all costs. So we want to file electronically. We want to get our refund directly deposited. We don't want to go anything going through the mail. As I referenced last month, the mail is like kryptonite. Paper just does not work well with the IRS. They're understaffed and have been so for a few years now, and they're still working from a backlog from last year. So we want to avoid paper at all costs. While we're filing electronically, we want to make sure that we include all of the information that is necessary for a quick processing. So, with the pandemic situation, there were stimulus payments that went out. This year, there also was an additional child tax credit that went out. And there are letters that the IRS sent in regards to this. So we had the 6419 for the child tax credit and the 6475 for the stimulus payments. And I want to urge you with these things, if these particular pieces of documents, the information that you submit is not correct and doesn't match the records that's on file, you will have a severe delay in your tax return actually being processed, not to mention trying to get a refund. So it is of critical importance that these numbers are right. If you don't have the letter, there are ways to go through the site to try to get the information, as well as you can always go back to your actual bank account and make sure those numbers are correct. Because there's nothing anyone can do once it's out there processed with incorrect information that's going to stop that delay. So we can't spend money that we don't have. Along those same lines, anytime that you get a advanced healthcare credit, if you're having your insurance through the marketplace, that also is information that has to be included, and you have to make sure it's there, because if there was a premium tax credit that was given in advance, they verify that information as well. And with that information, if it's wrong, again, we have a severe delay, and you may not have your tax return processed until the end of the year. So sometimes you'll have healthcare maybe the first couple of months of the year and forgot about it and didn't go to the actual site and pull down your form. So get all of the information that's correct. You want to have that there. I would also recommend getting an online account with both the IRS and the state of Illinois. Illinois is mytaxillinois.gov. The IRS is supposed to be doing away with the facial recognition feature. There have been problems with that. Facial recognition software has been known to incorrectly identify people of color. So not only do some people think that we all look alike, but some artificial intelligence seems to think that we all look alike as well. So, but that is going to be rectified, at least that's what they say, and we want to get that done. So before I get into some of the common questions, I do want to make a few comments about the earned income credit. The earned income credit has some changes for 2021. And it's been around for a long time, but there's some things that are new. So traditionally, the age limit was either you had to be at minimum 25 and the maximum age that you could be is 65. They've actually changed that. So for my seniors out there that are working a job in addition to having retirement income, there might be a bigger advantage for you this year to actually file, because now you may qualify for the earned income credit. The income limits, as far as the amount of money that you can make and claim the credit, has gone up, and the amount of credit that you receive when you don't have dependents has also gone up. So in some cases, that amount has gone from what normally would have been $500 to $1,500. So if you find yourself in that situation where you are a senior and maybe you had just Social Security and you were doing an outside job in addition to that, and you didn't file because you weren't going to make enough over the filing requirement, and you didn't have them take anything out. So you may not have been thinking that you have something coming back. You may actually still have something coming back with the earned income credit. So it is definitely something to look into. So that's the top end of the age restriction. And the bottom end, that's also been reduced. So it's gone from 25 to 19 if you're not a specified student, qualified foster youth or qualified homeless youth. If you are, the age is 18. So if you're in a situation where you're working and you're not a dependent of another, and you couldn't take the earned income credit before because you weren't 25 years old, there's a situation now in which you can also qualify for the earned income credit. And all of these things are new for this year. Also, if you are married filing separately, there is a mechanism under certain circumstances in which you can qualify for the earned income credit too. And so what you need to have in this situation is you need to have not filed a joint return, uh, reside with a qualifying child for earned income credit purposes, and have not lived in the same household as your spouse for the last 6 months of the year. So it's, it's a rule that kind of lets certain taxpayers qualify as head of household that has been shifted over to actually you be included in the earned income credit. So there are circumstances now in which married filing separate people can actually get the earned income credit too. So that's the new stuff. That's the not gonna go into very long things because this is a lot of information and you can't get everything all at one time. So I'm gonna do like my friend Pastor Ford says, do the mini skirt version where it's long enough to cover what's needed, but short enough to keep your attention. So with that, I want to move on to some common questions that we have. I've already dealt with the delays. Uh, the second thing I want to go with is we talk about these stimulus payments. Well, why do I need to supply these information for these stimulus payments that you said, brother? I thought these weren't taxable. And they're not. But if you did not receive the amount that you should have received, they're going to reconcile it and give you an additional amount if you were shorted. And it's not going to work in the inverse. So if you did receive more than perhaps you should have looking at this year's numbers, they're not going to claw it back and ask it for you to give the money back. The only instance in which I can think of in which something like that may occur would be if the benefits that you got were for someone who was already deceased and you were just collecting the money under the guise in which they were still alive. But other than that, there is no penalty for supplying the information. But again, if that information is incorrect, it's going to have a severe delay in the processing of your return. Another common question I want to deal with is the advanced child tax credit. So the question is, weren't these stimulus payments, these payments that I got from July through December? And the answer is no. Those were not stimulus payments. Those were actually advances on the child tax credit that you're going to get this year. That credit in and of itself was increased from 2,000 to 3,000, and if your child is under a certain age, that 3,000 is actually $3,600. But the payments are an advance on that credit, and when you file, those advance payments received are going to be reduced, and the credit you get is going to be the total credit minus what you took in advance. So these were not stimulus payments. These do have effect on your actual tax credit. And this, unlike in a stimulus situation, if you receive these advance payments for it and you weren't entitled to them, these you will have to pay back. The next question I want to deal with is what if I didn't get my stimulus payment? Is there still a way that I can get that? And the answer is yes, but in order to do it, you're going to have to file a tax return. So there is no more online non-filer tools. So that option is no longer on the table. So the only way to do it, if you have not received your stimulus payments and you are entitled to stimulus payments, is to file a return and then claim the rebate for the recovery credit. Sorry. Along in this pandemic, a common question that's come about has been, can I deduct the expenses that I'm incurring from working from home remotely? And as a lot of things are, this actually depends. So if you are an employee and receiving a W 2, then the answer is no. Unfortunately, with the Tax Act of 2018, those unreimbursed employee expenses were taken out. So that deduction is no longer available. But if you are self employed and you pay your 1099 as an independent contractor and you meet the other requirements for a home office, you can actually deduct those expenses. Those have to be a place to use exclusively for business purposes and business being conducted on a regular basis, just for the abbreviated version of that. But yes, you can in that particular situation. But unfortunately, if you are getting a W 2, the answer is no. You cannot get a deduction for those additional home expenses that you've been incurring while you've been working remotely. The next question I want to deal with is, are my unemployment benefits going to be taxable for 2021? And the answer is yes. There was an exclusion for 2020 on that first 10,200, but that was for 1 year only. So if you receive unemployment benefits in 2021, those amounts are going to be taxable. You're going to need to have that information from when you file your taxes. You say, okay, I hear you talking about these tax deductions and tax credits. Now, which one is better? Is it better to have a tax credit, or is it better to have a tax deduction? Well, if the dollar amounts are exactly the same, then the answer is better to have a tax credit, because a tax credit is dollar for dollar. So if I had $1,000 tax credit, it's going to reduce my taxes by $1,000. If, on the other hand, I have a tax deduction, it's going to reduce my taxable income by $1,000. And if I'm in the 22% tax bracket, that means it's going to reduce my taxes by $220. So it's better to have the $1,000 tax credit, which is reducing my taxes or increasing my refund by $1,000, than it is to have the tax deduction that's going to reduce my taxes by $220. All tax credits aren't refundable, so there are some whereas if your tax liability gets down to zero, you cannot get anything over and beyond that. But the refundable credits, even if your tax liability is zero, you will receive that amount over and beyond anything else that may come from your situation. As far as record keeping goes, a common question is, how long should I keep my tax records? And the preference changes on individuals, but I will say this: for the minimum that you should keep your tax records is 3 years. That's the open period that the IRS has to come and audit you, and that's also the open period that you have to discover if there is something that was not correct on your end and submit an amended return to make a correction to that. So at the very minimum, you need to have 3 years of your tax records. If there's a situation in which there is what they call a material overstatement or misstatement rather, which would be like 25% or more of your income, the statute of limitations, which is the time that they can come back and make adjustments to your account, is 6 years. So if there's a situation in which that could be, you'd want to have your tax records for 6 years. So like my ultra conservative people, I'll say 7 years, and then just start cycling things out after that because you've gone 1 year beyond the minimum and the extended. Now, I will say one thing: if there was a situation in which the tax return was a fraudulent tax return, there is no statute of limitations on that, so they can come back on that at any time. Next question. I say, okay, so since I don't owe any taxes, can I just wait until I'm ready to retire and collect all of my refunds then and kind of make up a nest egg? And it may sound silly to some of you, but there are people that have been told that and believe that. And the answer to that is no. So even though there's not a penalty for not filing when you have a refund coming back, if you wait longer than 3 years to submit that return, then the government no longer has the obligation to pay you back the money. So now you forfeited that money. So in that particular plan in which this person did that, I hate to be the bearer of the bad news, but they only got the last 3 years, and all the other things that they were planning on or hoping to get, they were not able to get. So please be very mindful of the sources that giving you information because this misinformation can cost you thousands and thousands of dollars. So he said, okay, then, brother, I hear what you're saying. So then can I go ahead and just not file my return for 3 years and then I don't have to pay them anything that I owe? No, it doesn't work like that. So the statute of limitations does not start. So there's a statute of limitations on collection of like 10 years. So if you owe anything beyond, if they don't get it in 10 years, then the time is run out. But that clock doesn't start until you file your return. So if you haven't filed your return, there is no start of that clock. So the 10 years has not come about. So you will have to wait. So that is not a viable option. And once again, like if it was a fraudulent situation, there is no statute of limitations on fraud. So, okay. Another common question is, well, can I just wait till next year and put the income or the expenses from this year and combine it with next year and just file it all together? I don't really feel like doing it right now. And the answer to that is also no. Each tax year is separate and stands on its own, and the income from that year can only be offset by the expenses or deductions from that particular year. You can't carry it over and just lump it all together. It has to be done at its proper time. So it's a cutoff theory in the county. It's matching it for the income and the expenses. Next question. Should I itemize or should I use the standard deduction? And again, with a lot of answers, that it depends. So what you want to do is you want to use the one that is the most advantageous to you. Now, I will say that with the current law, with the increase of the standard deduction, there are more people that it's advantageous to use the standard deduction now than to itemize before. But you can use whichever one is going to give you the greatest tax benefit. And it doesn't matter if you do one year and the other year, whichever one is the most advantageous to you. So the problem is now with the limitation of state and local taxes, that total amount being $10,000 in that section, less people are going to qualify that have very high real estate taxes or paying very high state withholdings from their W-2s. But if that, for a single person, if you can take that plus your mortgage interest and your charitable contributions and that amount be more than a little bit over 12,000 now for a single person or 24,000 as a married filing joint couple, then you take the itemized deductions. If it's less, then you take the standard. going to do whichever one is most advantageous to you. And there is no problem with doing it one way one year and a different way the next year. Which brings the question to say, well, can I still deduct charitable contributions? And yes, you can. Again, you're going to have the combination to be the greater of the two. But also for this year, it's the last year. They started in 2020, but also in this year, if you're single, you can take the standard deduction and add another $300 in charitable contributions to that, and that number is 600 if you're married filing jointly, and you can take the standard deduction plus that amount. So you can still take it. This additional 300 slash 600 is going to expire after this year, so this is going to be the last year that is available to you unless they extend the law, but it's scheduled to expire this year. And the other thing with itemized deductions question is, can I deduct my medical expenses? And yes, you can, because medical expenses is another thing that's in there, but it has a floor that works like a deductible in your insurance. So you have to have an amount over that. So you have 7.5% of your adjusted gross income. So you take that adjusted gross income, you multiply it by 7.5%. Let's say that number comes out to $7,500. Well, you would need to have $7,501 before your first dollar went towards your itemized deductions, and then anything over that is going to be added to the things that we just mentioned. So those are the things that you can do when you're itemizing. And what other questions do I want to address? Just got a couple more minutes probably before we're going to take this to the end. I thought I had a 15th one here. I only see 14. Alrighty. So I want to start closing it down as far as the frequently asked questions. Remember, the vision of the church is to help you to get out of debt. So we want you to get out of debt, and maximizing your tax refund or minimizing your taxes is a way to kind of have some more funds available for you. Debt can be an albatross. So what we wanted to do in this platform is to give you information that you can use every day and to begin you on a journey to get out of debt and into a new lifestyle and to not repeat the cycle. It's easy to get into debt, and it's easy to get into the cycle of paying it off and then slipping back into the debt. But what happens is the money that we get fronted on the front end to take care of some expenses, we end up paying that back and much more with our debt. So we want to keep that under control. So we're not looking for just a momentary, temporary fix. We're looking at a journey, and we're looking at a lifestyle change that we want to come about. And that's what we want to use this platform for. So we want you to be encouraged and move on in a way that will help you to do that. How am I looking on time, George? Okay. All right, so we get down to the last minute. I want to thank you for coming out. I want to thank the pastor for having the vision to actually give us this platform to help the people of the church. We want you to be kind. We want you to be blessed. We want you to stay encouraged. And remember, the church is opening back up next Sunday. We'll be available for an in-person service. So God bless you and have a good night.